What's up traders, this is Deepak Bangar, and in this video we are going to see what is the difference between trading versus investing, or difference between trader and an investor. This is going to be a two-part video. In the first part we are going to see the differences between these two ways of making money from the stock market in detail. We are going to discuss about the advantages and disadvantages of each of them, and in the second part, which is going to be very interesting, where I will reveal my views about what I think trading is better or investing is better. And trust me, you might get shocked about what I'm going to reveal with a lot of examples, practical examples of different stocks, which we are going to discuss in the part B of this video. So make sure you are subscribed to the channel so that you will get notified when the next video comes on this channel. So let's get started. Let's first find out what is the definition of trading and investing. So trading means the frequent buying and selling of shares or the stocks for getting the periodic profit. Investing is nothing but the buying and holding of stocks or the shares in the expectation or anticipation of realizing a long-term growth in the long-term price appreciation of the stocks over the long period of time. So trading is a sort of a period of holding of the stocks in trading is on a short-term basis, maybe few weeks, few days, few weeks, few months, at the max couple of years. In investing, you generally hold these stocks for longer term, and by longer term I mean is few years, maybe few decades. Also, trading aims, or a trader aims to capture the short-term trends in the stocks. See, stock doesn't move in a straight direction. It always moves up and down, up and down. So this is a cyclical movement of stocks in the stock market of different shares. And what a trader typically aims at is to capture those strong moves, the major moves or major trends which are there for the short period of time in that particular stock, so that he can ride the momentum and get the benefit of getting the returns in a short duration of time. That's what a trader aims for, capturing the short-term trends of the stocks. As against, the investor is more focused on long-term growth perspective of that company. So he is not doing the frequent buying and selling. He is not exiting the stock in between when the stock is reversing from its main trend. He just holds the stock in up and down phases of the market, and at the end, in the long run, after many years, he expects the price to appreciate. So that's the difference. Now the goal of a trading style or trader is income generation most of the times. He wants a regular cash flow, regular income by doing this buying and selling of the shares. As against, an investor is mainly focused on creating the wealth, the long-term wealth, through the power of compounding over the long period of time. Now let's discuss about how money is made in trading and investing. So a trader typically makes money by periodic profit booking via buying and selling of shares. So there is a turnover, he buys low and sells high. There are different ways of earning from the investing. Okay, it's not just the capital or the price appreciation of a stock. Of course, that is the primary objective, and investor makes money by the long-term price appreciation of that particular stock price. That's one way of making money, but that's not the only way. Okay, there are other ways of in which the investor makes money. For example, dividends. These are the small payouts which come when a company makes profit, so the rewards its shareholders in the form of dividends. As whatever the number of shares that you are holding, you will get X rupees per share of dividend or extra income. Then another way of income is stock splits or bonus shares. Now the method of analysis, how a trader analyzes the stock market for doing the trades. The main frame of analysis of most of the traders is the chart analysis or the technical analysis or the price analysis. As against, an investor typically analyzes his stocks on the basis of fundamental analysis. And fundamental analysis is nothing but the study of different factors related to economy macroeconomic and microeconomic factors which affect the long-term growth potential of the company and in turn have effect on the price of that particular share. So the traders, they directly analyze the price, which is the effect of different causes, but ultimately this is reflected in the price of a company. So trader does this visual analysis via charts, while an investor is more focused on different like for example different ratios, different economic factors for doing the valuation of the stocks and buying those or choosing the stocks to invest. Tracking of markets or the type commitment which is required in trading is relatively more compared to an investor, where investor doesn't have to track the markets on a daily basis. Now, next important question, and this is going to be an interesting one. Difficulty level. Majority of the people, they tend to think that the trading is very difficult and investing is relatively easy. This is what the common notion is, but I personally feel it's not completely true. Yes, I agree that the time frame of holding of the shares, where time is your friend in investing, it makes your job much easier. It is easy, there is no need to track the markets, no need to learn the stock chart analysis, so all these things are there. But it doesn't mean that investing is easy, because if it was so easy, anyone would have invested in, or anyone would have found out the good stocks to invest, and they would have made a lot of money out of it. But unfortunately, let it be trading or investing, more than 90% of the traders or investors, they ultimately end up losing the money in the market. And why this happens is because of the different factors apart from doing the analysis of or how a person analyzes stocks. So it's not necessarily true that the investing is easy and trading is difficult, in my personal view. And we are going to go in more detail in the next video about this aspect. Risk level. Another notion is people tend to think that the trading is a riskier compared to investing. It has got a high risk and investing is a low risk. But I again would like to disagree with this approach, because there is a risk involved in both of them. The nature of risk, the amount of the risk, and the way we manage our risks are different in this style of trading and investing. But since the time is in your favor in investing, the majority of the risk are already minimized, but that doesn't mean that investing is a low risk approach in my personal view. Ultimately, it depends on what you are holding or what you are trading. That actually makes a lot of difference. Another difference is time can work against you sometimes in trading. For example, when you are trading futures and options, there is a definite time in which the price should move in your favor in that particular time window. So there, if that doesn't happen, then actually the time is working against you. So the probability of success are relatively low in those styles of trading. But as against in investing, time is your friend most of the times. But again, not always, because there have been lots of examples where we have and we are going to see those stocks, okay, where there was immense rise in the price of the stocks over a few years, and ultimately only to realize that the stock price has again fallen back to its previous levels, what it was before 5 years, and ultimately it went down even. What is more profitable? Where can you make more returns on your capital, whether it is trading or investing? My clear-cut answer would be you can make more returns on your capital on trading compared to investing. But okay, there is terms and conditions apply. The probability of achieving that high returns also comes with high risk in trading compared to investing. Trading does give you better returns compared to investing, and the logic is very simple. Whenever there is a trend in the stock, the movement of that stock becomes very fast, and you tend to capture that. If you are able to capture the main chunk of that trend, then you can make higher returns in a relatively short period of time, and you can just go on repeating the same process when you are a trader in that particular stock or even other stock where there is an opportunity. But what happens is when you are an investor, you are stuck with that stock if it turns from your point of entry into the opposite trend. For example, if the price goes down, starts going down, if the stocks shifts its trend from uptrend to downtrend, then you have no other option than to wait. And for how long you have to wait, nobody is sure. So relatively, trader will be able to make more returns on his capital compared to a pure investor. The risk of capital getting stuck is very low in trading. Most of the trading strategies, the proven trading strategies, they have the predefined exit criteria. And they have a way of risk management with respect to the stop losses or the other ways of managing the risk. The exit is already predefined in trading. So there is no question or there is no much challenge when it comes to the question of when to sell the stocks. Okay, as opposed to investing, where this is the major challenge. Most of the people, they literally struggle with this challenge of when they are investors in the stocks. They literally find it difficult about when to exit from that particular stock. That's always a challenge in investing. And the risk of capital getting stuck in the stocks which are going in the downtrend is always high in investing compared to the trading. As I said, exit is easy in trading, but when it comes to exit or selling a stock, it's a major challenge in investing. Another important thing, okay, you can take advantage of both the bullish phase of the market and bearish phase of the market, both of these phases when you are a trader. In bullish phase, what traders typically do is, bullish means the market is going up. So in bullish phase, trader buys the stocks at lower price and he sells the stocks at a higher price. So that's how he makes the profit. In the bearish phase, when the market has changed its direction from up to down, there is a unique concept in stock market called as short selling, where you sell something at a higher price and then you buy that particular stock at a lower price afterwards. This is called as short selling, and this is a unique way of making money in a faster way from the stock market by doing the trading on the both sides of the market, which is possible when you are doing trading only. And this thing is not possible when it comes to investing. An investor can only take advantage of the bullish markets. He can only buy low and then he has to sell high, but he cannot do the short selling because of the nature of the markets. And that is again one of the very important difference between these two, trading and investing. Bearish market for a trader means there are abundance of opportunities of high returns to the traders, as opposed to investors. Bearish market is equal to more waiting time, and bearish market is something where the investors, they look for the buying opportunities in the stock market. These were few of the key differences between trading and investing. The question comes to your mind is, what is better, trading or investing? This is a tough question to answer, but I'll try my best. In my next video, we are going to see some examples. I'm going to share with you my perspective on what exactly is truth, which could be shocking to, by the way, to many of you, as to what I think, whether trading is better or investing. So for that, you need to subscribe to the channel and make sure you watch my next video. At the end of second video, you will be able to decide for your own whether trading is for you or whether investing is for you. Thanks. I'll see you in the next video.